Hey everyone, welcome back to the channel. Today we're going to take a look at BlackBerry. So this seems to be the hottest new stock from WallStreetBets over on Reddit. Um, so first we'll go ahead and pull it up here and you can see kind of some of the trends that have been happening recently here and with their stock, and you'll see the last month, right? You'll see back in what, 10 days ago, um, it just kind of shot up. And really what happened here, I think this is kind of the next wave or the follow on. If you look at GameStop, similar story here. If we go back to early January, it's hovering 20 bucks a share, 13, 15, depending how far back you go, and it was $4 in August. Now it's all the way up to 65. So I think BlackBerry is experiencing something similar to GameStop, just not to the full extent. For those of you that aren't familiar, there's an online community called WallStreetBets, and it's a sub of probably mostly millennial people that take extreme amounts of risk and talk vulgarly to each other in an interesting fashion. But so you'll see right here, I mean, on the front page, do not sell GameStop for BlackBerry or Palantir until they've hit 1,000. So basically what happened is this whole community, I believe the community is 1 million+ people. Now, obviously not everyone's an active participant, but 2 million people. There's 2 million participants, and it's basically a stock trading forum. And they found out that there's a handful of hedge funds that were very short on GameStop at like $20 a share. So in their all seeing wisdom, they decided, let's go long GameStop, buy all the stock that's out there, and make it so there's a short squeeze that happens. And there's a lot of argument about has the short squeeze started or not. But anyways, that's GameStop, and you're seeing something similar with BlackBerry. It's recently picked up a lot of hype on this subreddit, and you'll see the stock price start to shoot up, and it's similar in nature of FOMO from people. So that's a little bit of the background on BlackBerry and why I'm taking a look at it. So the first thing I did is I went over to sec.gov. This is where you can just pull up their filings, type in their ticker here, BlackBerry, and you can kind of read through. So I pulled up their 10Ks and I pulled in their recent financial information. And what's interesting is for me, BlackBerry was the company in the 2000s um, that made cell phones, right? Um, Today, I mean, that's not the case. They don't make cell phones anymore. They still have a little bit of cell phone revenue, but it's through third parties where they just kind of license the name that I discovered. So this other line of revenue, $21 million of other revenue, that's kind of like third party selling. And at first I was confused. I looked and like they didn't have any inventory. Um, so they've actually completely pivoted. Um, so this isn't the BlackBerry of the 2000s that makes phones. They're much more in kind of the security space and Internet of Things. So you can see their Internet of Things revenue hasn't really grown, but it's substantial at about 550 million a year. Licensing. Um, so they have licensing agreements. The big one was with BBM licensing agreement. To be honest, I didn't really look more into that, but I'm sure if we Google it, something will come up. So we could see what that is. Solution licensing. Um, yeah, I mean, global consumer BlackBerry BBM license. So I don't know. I guess they're just licensing out there, um, and maybe this is just licensing the brand. Yeah, so it looks like the licensing piece is them licensing their brand, and then the other is they have the legacy handheld business, but it's manufactured by third parties and then sold, so they never actually hold the inventory or pay for it. I think they just take a royalty there. And then Silence is a company they acquired. And so these 2021 numbers here in their 10K, they state kind of projections for 2021. They expected the legacy business to be flat. They actually expected the licensing to decrease from a loss of telemetry licensing. they expect 20% growth on the Internet of Things, and then their Internet of Things they actually expected to just be flat. And the reason behind here, I typed in the notes, it was slowdown from automotive market related to COVID in 2021, slightly offset by security and endpoint services. So really BlackBerry nowadays is more of this like security technology software company than it is a handheld phone. And I've copied in their 9 months ended of 2021 financials, but you can see, I mean, revenue's about $1 billion. Gross profit's pretty healthy, right? I mean, they're mostly a software company, so that makes sense now. R&D, pretty high. SG&A is, that's 50% of revenue. That's pretty high. My guess is they have probably a relatively bloated organization still from their legacy handheld business. And they, at one point, they were the dominant cell phone maker, so they were growing rapidly. They hired a lot of positions, and there's probably a handful of people still sitting around in the org that maybe aren't needed. But who knows? Maybe they've gotten rid of all of that. It has been probably about a decade. And then you'll see there's just some like other random changes, but on an operating income perspective, they are not profitable. But we'll go ahead and forecast out kind of revenue, and then we'll see from there how their cash flow is looking, and we'll see if we can come up to a valuation. I don't think it's going to be anywhere close to their current stock price. I think what we're seeing is just hype from the broader, like really just broader Wall Street bets and things of that nature. A lot of institutional investors, Jim Cramer is giving a lot of airtime to Wall Street bets. So there's a lot more people taking this stock form seriously than there has been in the past. So um, yeah, I don't know. It'll be interesting to see what we kind of come to, but we'll do a 10-year DCF here out to 2030. For the revenue, really, um, I think I am going to look at the revenue by business line. So for this, I mean, they're expecting 20% growth year on year for this acquisition. I don't see why that's not feasible for the foreseeable future until it becomes kind of a big business. So we'll give them that credit here because I think they're going to need that to get any sort of fair growth here. In Silence, or however you pronounce it, um, let's see what this is. I honestly didn't even look up the um, like what the company does, and I mean you can see it's actually grew 6%. But that's overall. So Silence AI to protect endpoints. So I mean it's a AI-based security system. So yeah, I mean that's probably reasonable that it continues to grow 20% for a while. Who knows? Maybe it grows faster or slower, but we'll give them credit there. I mean, you can see this Internet of Things business has basically been flat. I'm going to call this kind of a mature business, and we're just going to have it grow at kind of inflation. We're going to say they're going to be able to keep pace with inflation, 3%. We're going to give them 3%. And inflation, you could argue is lower at 1.5 or whatever the inflation's been recently, but we'll give them 3% growth. Um, licensing, I mean, this is their cell phones. Honestly, I don't think their cell phone business is going to keep growing. I think it's going to slowly go away. I think they've missed the boat there. And to be honest, though, the way licensing works, I have done a lot of licensing um, experience in the past for a Fortune 100 company, and these agreements are going to be usually 5 to 10 years. They might have contract details kind of in the actual 10K. I didn't look for it, but it'll be like a 5 to 10 year contract, and then there will be like a renewal period, and then at the end, there could be a renewal at a higher rate or a lower rate. But a lot of the licensing, it's going to be two components. There's going to be like an upfront fee that gets paid, and this actually gets amortized over the life of the licensing agreement. So it would be like deferred revenue or something. And then there's going to be a royalty stream usually that comes along that, I don't know about the cell phone market, what the royalty stream is. I was working in the healthcare space and we had royalties that were anywhere from 5 to like 25%. It just really depended on the product and how old the product was, how much time was left. And a lot of our stuff was covered by patents. So you weren't licensing the brand, you were paying a licensing fee to access our patents. Um, So, I mean, I'm guessing here you're paying for the BlackBerry name to be able to create a smartphone in India, slap BlackBerry on it, and sell it to the masses there, and say it's this great brand. So, I'm gonna hold the 250 flat for. I'm gonna give them 5 years here. I'm gonna say they're gonna get the 250 million that they're currently seeing because they just lost their big agreement. They're gonna hold flat at 250, and then from here, I think it, you know, I mean, here it's all speculation. Do you think BlackBerry can recover its brand in emerging markets and take market share from Samsung, the Android-based phones that are a cheaper alternative? I don't know. So, this one actually, this is a tough line to forecast. I'm going to leave it flat for now. And then this is going away. This is their legacy, them manufacturing. They've stated that this is something they're not going to keep. So I'm just going to have this slowly die off over the next 10 years until it goes to zero. And I mean, you can see the decline here. It's been fast and it's been real, right? 185, 59, 21, 21. So that business has been dying. It's not going to stick around. So we're going to use these numbers for our top line for now. I think these are fair, reasonable projections, and we're saying the future of this company is really silence. It's their security. They're going to take that security platform rolled into their broader Internet of Things stuff, which has some security, and from there they're going to be able to, become this new McAfee, Sentinel-1, whatever these security companies are that do different types of security. I think I don't want to say for sure, but I think BlackBerry was mostly like mobile security, which I think is something that not a lot of companies focus on as much. So there we have it. We'll link this up now over to our DCF, and we'll kind of just see. No, we don't have a 2017. We'll see how this kind of all plays out in the model, and we'll kind of go from there and see if these things are reasonable, unreasonable, and what's really happening there. And oh, look at that! In my wisdom, I set the sheet up to actually track each line individually, so you could. That exercise we just did, I set it up so you could do that on the sheet, but that's fine. We'll link that up, and then that should just be a sum. COGS, we'll link COGS up real quick. And honestly, I mean, over time, I don't know, it's hard to say what's going to happen with COGS. I'll probably just hold it constant to 2020 because we're saying they're going to be growing in the silence business and the Internet of Things, which looks like that's mostly been what's growing in the past for the most part. And because of that, I mean, you see a little dip here, and I think that's because you saw this huge dip in other, but then you see it kind of shoot back up, and that's coming from an increase in licensing and silence. So silence is bringing in a significant portion of COGS. So we're gonna calculate COGS as a percent of sales. So it looks like 26.6. So we're gonna leave that there at 26.6, and we'll see how that flows through. Oh, that should not be linked there. Let me just link this here. What does that link to? We gotta multiply it. There we go. So you'll see, COGS just keeping steady. Gives us our gross profit. SG&A, we'll link this up from the income statement. And we're gonna make this R&D plus SG&A. I mean, we could probably break out a separate R&D line, but it looks like R&D has stayed pretty consistent around this like mid, around 250. So I think honestly, if we link this up, we're not going to see, yeah, I mean, you don't see too much change here. And then if we look at SG&A as a percent of sales, 72%, that's got to come down for them to be profitable, right? So it's either they got to cut back on R&D, they got to do something, that's for sure. At this point, they're never going to be cash flow positive with this insane SG&A there. So I don't know. We'll see how this all kind of works out. DNA, we can link that up. I think that'll be on the statement of cash flows. link that up. And then link this up here. We'll kind of see. Yeah, so I mean, not cash flow positive. And then when we link up the CapEx as well, that's just going to make things worse. Same in cash flows, PP&E. So they actually don't have a lot of PP&E add-ons. So their amortization is way higher. That seems weird. I don't know what's causing that. That's something that might be worth looking back into. I don't know if they have a lot of legacy, like if their old business was CapEx intensive, that the new business just isn't. But right, like you're not going to be able to maintain depreciation like that. That's weird. Yeah, we should look into that. Let's go to their 10K. Where's the most recent one? Try and see what's going on there. Acquired intangible assets. So basically they're amortizing purchase price of intellectual property. And here's their acquired intangible assets. Is this 3 months ending? So we might need to add that into purchase of PP&E. Do they have is this 9 months? No. We need to find like the year end, not the 3 months ended. Fiscal year. Here we go. So these are the numbers we're going to want to add into their PP&E. So let's go back to our model here. Let's look back at cash flow. So we're going to have negative 95 minus 2018 was 95. Equal sign here. And this should make a little bit more sense now when we look at things. So this was 82. And then this one is, what was it, 105? 141. Okay, so now things should look a little bit more normal. So now we'll see the CapEx is a bit higher. Yeah. And so obviously they're still amortizing more. So we'll just have to kind of see, but it looks like CapEx now is about 11 to 14%. So we're going to actually, I'm going to link it back to closer to the 12% and just hold that flat for now. And then this becomes a formula, right? So it's just times negative sales. So we have that all linked up. Something seems weird here. That should be, we want this to, oh, this signs in here is negative, but our CapEx down below is negative. So there we go. Now we can kind of start to see how all that's flowing through. Taxes, I mean, yeah, we could say they're gonna, I mean, realistically though, until they're kind of cash flow positive, they're not gonna be paying taxes. I mean, I guess maybe they'll have some credits, but that seems a little bit, I think I'll probably just actually delete that until, I'm not gonna give them credit for taxes until they're actually generating profit. Then they'll start paying their taxes. And obviously, you know, maybe I'll actually just remove it because I'll have carry forwards from losses. So, and then D&A has to keep going down. It can't stay above because they're definitely in a growth state. So there's growth CapEx. So this should ultimately come back down closer to, but it looks like it's been dropping 10% a year. So my guess this was just they had a lot of intangibles that they bought a while ago. So I'm going to bring this down until it's at like around 70%. And then we're going to say they have 70%. What's that saying is basically every year 30% of their CapEx additions or growth CapEx. So the depreciation isn't quite caught up there. And then the depreciation amount now. So this is as a percent of CapEx. Let's times that, and we'll make that negative to flip the sign. So There we go. And you should see it kind of level out to more normal. So yeah, every year the CapEx is a little bit more than the depreciation, which signifies that like they're spending money to grow the business still. Um, and you can see in this scenario so far, I mean, they're not cash flow positive. I mean, even if you gave them credit for the taxes, right? Even if you're like, okay, you know what, we're going to give you um, the 21% times EBIT, we're going to give you that, right? Like, we're going to give you all these tax credits and stuff, right? Um, I mean, they're still not a cash flow positive company. Um, and the big thing here, really, I mean, wait, what's going on with the gross profit? Oh, okay, so maybe things are better. Maybe my formulas are just screwed up. I was like, that looks really bad. That might make things better. There we go. Okay, that makes things much better when we adjust that. So now we're saying that they're cash flow positive, which I think is a better sign um, now that that formula is corrected. So they are cash flow positive, which is good, but it's not anything crazy, you know, $50 million a year, um, and you're paying, I mean, what are they trading at? $8 billion market cap, barely generating much cash, and I'm going to guess they have a lot of debt on their balance sheet. Maybe they don't. Um, and we still have to, I guess we still have to do working capital. So let's link up their current assets from the balance sheet. So, oh, okay, so we only have 2019 here, so I'll just start this one. Um, so you don't, for working capital, I don't include cash, but you do like AR, you do other receivables, and then I'll throw in other current assets. It's probably questionable, but we'll link that in. Um, we can copy this formula over, and then I guess these are actually all C because my sheet's backwards, so change those real quick. I'm just all sorts of typos there, make that a C. There we go. Now we'll do the same thing with current liabilities. So we'll do AP, we'll do accrued liabilities, and then we're going to ignore those two. Okay. And I mean, you could include deferred revenue when looking at the cash flow. I don't know if my model's quite complex enough to capture that. The idea here is like that is cash coming in, right? Like all that deferred revenue, they actually did have cash, but at the same time, so it's not reflected in their top line revenue number. So, you know, actually maybe it is a good idea to include the deferred revenue. The problem is like our projection, I guess, for next year, for 2021, 2022, part of that revenue is the deferred revenue. So then we're like almost double counting it. You'd have to build out like your forecast and you'd have to back out the deferred revenue from the top line revenue growth if you wanted to count it here. So, I mean, it's a little wonky to be honest, but I mean, 264,000 isn't, or 264 million. Um, I mean, and this is like the balance of it, right? So in 2020, right, it's 264, it was 253 the year before. So, I mean, it's growing a little bit, but and this is most likely just tied back to their licensing stuff, right? Like they get an upfront payment, they have to defer that revenue over the course of the licensing agreement. Or it could be like customer deposits, but I don't really think there's much in that. Or if they have software contracts, if they get paid upfront for the software contract, for the security contract or something, they would have to amortize that over the life. Um, but I mean, it doesn't look like it's growing too terribly much, so I'm going to exclude it for now. And this should actually be D because I think this is linked to the 2019 scenario. Um, and then we'll make this C. So we're going to exclude that for now because it's captured in our top line. And like, sure, you could argue there's going to be a little bit of it, you know, from like a true cash flow perspective, like we should be capturing it, but I think it just makes this model we would have to break out the revenue and understand the deferred revenue schedule. So then we could back it out of the top line and then we could account for it in the bottom line, but then forecasting it forward, I think that just gets a little bit too tricky for the analysis we're looking to do. And then you'll see here the change in working capital. And what I'll do here is I'm going to link these up as well so it doesn't look like they're getting tax benefit for, or working capital benefit, just because it's not linked up. So then I got to make sure these are linked up right. These might not be off the right revenue line. Let me see. No, that is. Okay. And what about this one? Yep. Okay. So those are linked up right. I mean, probably just honestly hold this stuff constant for now. I don't like messing with working capital too much and assuming like that's going to be what makes or breaks your ability to be cash flow positive or not. That seems silly to me, but I think, you just kind of working capital slowly growing. It's slowly a use of cash. That's fine. It's nothing material. So I think that looks okay. We'll come over here now. 10% weighted average cost of capital. I talk about this in all my videos, but the main idea here is what cost of capital as an investor do you require for this investment? And so a lot of people will be like, well, what's the cost of capital for the company? Because that would reflect how risky the company is. And like, yeah, you could argue that and be like, oh, I want to calculate the company's cost of capital. I like to think of it as like, as an investor, my bare minimum, historically, the S&P returns like, what is it, 7 to 8% real return. So um, that's like a 12% in like with inflation adjusted, it's like a 11 to 12%. So like if I want at least S&P returns, right, I need 11% return here. Based off me needing an 11% return, this company today, I don't know if the net debt's linked up correctly, so we'll have to do that real quick. And if you don't know what net debt is, it's total debt less cash. So we got that. They actually don't have that much. Oh, that's the wrong year, right? Oh no, that is 2020. Okay. Wow, they paid off all their debt. I guess it just moved to, they issued notes to pay off the long-term debt. They just moved it from A to B. Got it. Or they came due. So they'll probably refinance it soon. You'll probably see that. So we'll do that, and then you subtract out cash. Oops. I actually think they have a fair amount of cash and equivalents, and short-term investments. Short-term investments, I'm thinking of that as they have marketable securities, something they can quickly sell. So you'll actually see that be a negative number, which means they have more cash than debt. So from that perspective, it lowers their enterprise value. So like if their enterprise value is this, that's saying like the total company is worth 1.6 billion, but if they have 300 million of cash, if you bought the company, right, you could instantly just pocket that $300 million of cash and the equity value is actually less, right? So equity value here is 1.3 billion. So that's how you kind of get to that valuation. So now if we kind of look at this, right, we can see, and realistically, BlackBerry, I would say this is a pretty speculative play, right? Like, are they going to succeed in the security industry? I don't know. Their Internet of Things revenue has been relatively flat. Their legacy business is dying. Their licensing business is slowing going down. It's really this new revenue stream they have from their acquisition, the silence. And 2019 isn't a fair representation, right? I think this was like 1 week or something probably of like revenue reported in them in the acquisition. I don't think in 2019 Silence as a company only did 5 million in revenue. You're not going to pay 1.4 billion dollars for a company doing 5 million in revenue. But they were expecting 20% growth here. If they can keep that up, right, it becomes pretty material. You can grow your other business rate of inflation, licensing. We're giving them benefit of the doubt. We're saying like that business is just going to stay flat. Their legacy handheld being just manufactured and sold by other companies. Um, and 10% will say S&P. We want you to mirror S&P returns. $1.6 billion equity value. And they are an $8 billion company. So, um, and that's at $14 a share. So, right, if we come back here, they were, let's look at the 1 month, at $6 a share, $7 a share. They were a $4 billion company, $6 a share. Yeah, I mean, they were a $3.5 to $4 billion company, right? You cut that in half. Um, maybe how do you get to 3.5 to 4 billion from here? You assume licensing is going to rebound, right? That could be the first thing. You're going to say, you know what? No, their legacy business or their brand is worth a lot, and developing countries are going to really love it, right? And going to go crazy for this. Um, and there's going to be a lot of marketing done by these third parties to make sure it succeeds. Okay, fair. We'll do that. And then their Internet of Things business, this was just a fluke, right? And let's look at 9 months ended. I don't think they broke it out. It's a fluke. It's going to grow, and it's going to grow faster than inflation. We're going to get 5% growth. In total, I mean, right here, let me just add like the total growth rate here. Maybe this isn't that absurd for a company that's doing $1 billion in revenue nowadays, like growing 8, 9, 10%. That's actually probably reasonable. That's probably not that far off. And now, okay, with those updates, you're at 2 billion. Yeah, I don't know. You got to get pretty bullish pretty quick, I think. Um, and maybe, I mean, the company said they expect Silence to only grow 20%. So, I mean, that's where it's tough. If the company revises that and thinks they can grow at 35%, right, then, and they think that this thing's just going to take off with them, then sure, all of a sudden you're at the $4 billion valuation, pretty close to it. Um, but if you're trying to get to, I mean, like, yeah, I mean, it's hard to come up with a reason for why this company would be worth $4 billion. You have to really believe in their pivot into this like security space. Um, yeah, I mean, the $6 a share, actually, we saw a hump peak back in November, right? If we go back to just like last year, $4 a share, $5 a share, $3. I mean, that's the coronavirus dip, but at $5 a share, right, you cut this in a third basically. It's a $3 billion company. That's probably closer to being reasonable. Um, I mean, you're still being pretty optimistic. You're putting a lot of value in the brand that hasn't been relevant for a decade. Um, that's a tough call. It'll be interesting to see, though, as I was saying. I mean, if we go over to WallStreetBets, can I search just here and type in BlackBerry? You'll probably see, I mean, there's probably a ton of stuff. Um, yeah, I mean, this person, right? When was this? 4 days ago. This person bought 40,000 shares. They spent $500,000 on BlackBerry stock. Um, and it's just like, that makes no sense. Like, why? Like, if you're making I mean, unless if you're worth, $50 million or something, and that's just like, just messing around. Um, and yeah, this was an interesting one, right? It's Robinhood tells you what other people own, and if you own GameStop, you also own Palantir and BlackBerry. So I mean, it's literally these 2 million individuals on this subreddit are just driving the price of this stuff up. Um, and it's crazy. Uh, Here's someone saying, "Don't buy calls, buy shares," um, which is interesting. So I mean, it's an interesting subreddit. You got to get past the vulgar language and the way they talk to each other. It's not meant to be I think it's just supposed to go against cancel culture is their thought, but it's definitely um, a place where they are definitely driving stock prices nowadays. Um, but yeah, I mean, fundamentals don't say BlackBerry is a uh, $8 billion company. So something there is off. And what is it? GameStop, they got behind the Ryan Cohen joining the board and decided that that's the new GameStop story, when in reality, like, sure, but he's not going to turn around a failing retailer overnight, and there's no reason for its stock price to go up like it did. But it seems to be disconnected from um, fundamentals. I think, you could probably make an argument BlackBerry's a 3.5, $4 billion company if you truly believe in this acquisition and in some of their legacy stuff to continue to perform well. But yeah, it'll be interesting to see how it plays out. Same with GameStop. Following that, it'll be interesting to see, does GameStop kind of act like Tesla in the future, where it just holds some crazy valuation, or eventually does this subreddit sour on it and everyone dumps their positions and the stock plummets back down to $15 a share in the next month? Who knows? We'll see. And I mean, I think they have an earnings call in March for GameStop, so that'll be telling to see kind of what the Ryan Cohen story is. But yeah, thanks for tuning in. Hope you found this interesting. And it's an interesting speculative play by that subreddit, and I'm sure there might actually be some, like, someone else might have done some um, like thorough due diligence. Um, to be honest, most of my videos, right, these are like high level, how to kind of set up the problem and think through some of their issues. But if you really wanted to take a deeper look, you'd have to do a little bit more. Rumor that they're going to partner with Amazon on an electric vehicle platform. Okay. Um, they did partner around December, sold off their cell phone patents, settlement against Facebook. A lot of companies are working with BlackBerry today. So it looks like BlackBerry's in the car space. Okay, interesting. But like, Sony makes cars. I don't even know that, maybe Sony is an OEM for car parts. I know a lot of giant Japanese conglomerates are like that. So um, yeah, three things to think of. No revenue growth. Yep, we see that. EV doesn't take off. Well, in their 10K, they said they're worried about the automobile space. So there you go. And then a better platform over BlackBerry. Um, yeah, I mean, it'll be interesting. And I mean, there's a lot of people on here. Software, phones business reinvent itself back to the main player in automobile operating systems. Okay. Uh, self-drive. So I mean, I guess it's a car play kind of thing. Um, yeah, I don't know. Uh, it'll be interesting to see. I don't know how profitable being the base layer tech stack in a automobile manufacturer is. I would imagine most automobile OEM companies aren't high growth, super profitable. You just kind of get a base revenue for every car built. Um, Margins on cars are already pretty thin. They're not going to be able to start paying BlackBerry just absurd amounts. So I don't know. It's an interesting take that subreddit has. But as the one person pointed out, even with all these developments, you're seeing no growth in the revenue. So you're giving it a lot of benefit of the doubt to get to its current valuation. So hope you found this useful. Any questions or comments, leave them below. And yeah, thanks for tuning in.